Okay, it looks like hopefully we're going live right now. I think there's supposed to be a countdown, but I do see up in the right-hand corner that we've got a counter going that we've been going about 13 seconds now. As you know, my name's Dave Hall. I apologize. C. Art Saline is not with us today. You're going to miss him this week. He is traveling. He's on vacation, taking his son around, trying to look at colleges. Something that Ben has an opportunity to look forward to. I've already gone through that process with many of my kids. You will notice we do have someone else with us here today. Today, I thought it would be fun to talk a little bit about taxes. Now, you can still submit any questions that you have regarding retirement. Happy to have those questions come in, but please be aware that today we're going to ask Ben some questions about taxes. If you've got year-end tax questions that you would like to have answered, that's what he's here for, is to answer those. If you got retirement questions, I'll take those. And hopefully we have a good time just going through topics that can help you as you look at your own financial situation. So with that, Ben, welcome to the show.
Thank you, Dave. It's good to be back with you. I know we've done this a couple times in the past, years past, in different platforms, and it doesn't feel like that long ago, but it's great to be back.
No, it's always fun to have you here. So Ben is the tax manager at eTrends Group. He's worked with me now for 10 years, more than 10 years.
Yeah, it's been 9 years, almost exactly.
Okay. It's hard to believe that it's been that long. We have a great relationship. I feel bad now because I don't get to see Ben a lot. We used to be in the same office and be able to see each other once in a while. Now he's in Southern Utah and I'm in Tennessee. So if it's not this type of environment, maybe twice a year, I get to see you in person at some type of event we have.
Yeah, if that. I don't know. We saw each other a month or so ago for the first time in a very long time. So
yeah, it'd been way too long. With the pandemic, I've not traveled near as much as I usually do. And so it had been way too long. Ben, tell us a little bit about yourself. I mentioned the college side of things, that you have an opportunity to look forward to maybe some college trips yourself. Tell us a little bit about you and your family here.
Yeah, so I've got 8 kids. I think that's the most notable thing. People, I've got a picture behind me on the wall you can't see, but that's what everyone comments on first. They want to know if they're all from one wife. They are. Yep, one wife, 8 kids, no twins. So that's 8 separate births, and they're all me and my wife. So that's I think that's the first thing people notice. I love having a big family. I guess if you roll back the years, roll back the clock here, I started out, I didn't always want to be a tax accountant. I originally wanted to be an attorney, and I kind of fell into accounting fortuitously, I guess. I joined the military when I was 17 and got into military finance just because there wasn't room in the legal field at the time in Salt Lake City where I joined. So I figured I'd join finance, and then when there was opportunity, I'd switch over to the legal side in the Army, but I never did. And all the people I was around in the military were CPAs because I was in finance, and that's what I ended up doing. I'd spent 8 years doing finance in the military. I got a bachelor's degree from Southern Utah University in accounting. I did a master's of taxation at Golden Gate University. And ever since 2007, I've been pretty much doing tax work, and now, of course, doing a lot of advanced tax planning. So that's me in a nutshell.
Well, I know there's many people, including myself, that are very glad that legal thing didn't work out for you. I'm not sure for yourself if you've been as happy, but I know myself and others have been very grateful to have your skill and your knowledge to be able to use to make people's financial lives better.
Yeah, it's been a great. Yeah, listen, I tax is a lot. Tax is law. So it's been great. In fact, the tax code part of the law is the absolute worst part of the law, right? It's the most complicated. It's the longest. It's the craziest. It's the part that changes the most. So if I wanted law, I really probably picked the best profession.
So yeah, because you're liked better too. It's not like when you go somewhere, they're always going to, oh, it's the attorney. Now you can say, look, I'm the CPA, but in the background, I'm doing all this legal stuff, looking at the tax law.
Right.
So let's talk a little bit quickly about your kids. So so the oldest now is how old?
He's 16. Riley's his name. He's 16. He's a bright kid. He actually does. This whole pandemic thing hasn't affected him. He's been doing school online for a number of years already. and scheduled to graduate, pretty early. I think
That's
he's
right.
scheduled to graduate like, I don't know, probably the beginning of his what would be his senior year, because he's online. And
And the youngest, where do they fall? What's the youngest?
my youngest is 3, just turned 3, and she is just about the cutest person you could possibly know. And I'm not biased. I think anyone who knows her will say that.
7 boys and 1 girl. Is that correct?
6 boys, 2 girls.
6 and
Yeah.
2. I couldn't remember if the last two, correct? Last 2 are both girls?
No, I had 4 boys, then I had my first girl, and then 2 more boys and another girl. And
Okay, I remember there's a lot of years of boys.
yeah, I mean, back when we only had 4, we kind of joked we would just keep having kids until we had a girl, and then we had a girl, and we had a couple more. So there you go.
Yeah, that's great. Well, we're approaching the end of the year. We've got this situation where everybody out there seems to be wanting to make transitions, wants to get themselves in a position, take advantage of some tax rates, especially as we look forward to what's maybe ahead of us, especially for those in high income brackets. One of the things I know people always come to me about is they're like, hey, I want to go spend $1 so I can save all kinds of taxes. What do you do with someone like that? I mean, they're saying, "Hey, if I can spend $1, somehow they equate that's going to mean that their taxes go down by $1." Is that a good thought process? What's the situation there?
Man, that's common, isn't it? In fact, I have experienced this experience all the time. Most recently, just a day or 2 ago, a guy's sitting there and he says, "Ben, I don't want to pay any tax. That's my objective this year. What can I do?" And it took a long conversation for him to realize that in order for him to get to that desired no tax situation, he would essentially have to have no income. He's going to have to spend every dollar he owns almost to get to literally a zero tax position. And that's not always true. In fact, you on your podcast talk about like a zero tax retirement. So there are certainly ways to work your way in through your life, to work your way into a position where you're in a really favorable tax position. And actually, that's kind of what we do here at eTrends, right? I mean, we do advanced tax planning to get people into a better tax position. That's, making their tax position efficient. But it doesn't happen overnight. And certainly if you have a lot of taxable income today, it usually does not make a ton of sense to spend $100,000 so that you can save $30,000 or $35,000 or whatever it is. So, but that's not to say it doesn't make sense to try to minimize that liability. You just have to realize that reducing taxes often comes with a cost. Yeah. And if it doesn't come with a cost, of course, we want to take advantage of that.
And I think that's one of the things that people need to realize when we talk about tax-free retirement even. It doesn't mean that you're never going to pay tax. You do have that cost of entry. You've got to be willing to pay the taxes up front if you want to get to a tax-free environment. And part of that is dealing with marginal tax brackets. We talk about the top marginal bracket. I talk in one of my presentations, that being 37%. But when we look at it for individuals, obviously that's going to change for them based upon the income levels that they're at. Is that easy to predict? Is it easy to figure out where someone's going to be? Can they do that themselves?
Well, that's great, and that segues. I made some 2-cent graphs here before we got on to demonstrate this. So this one here, I want to show everybody. Hopefully you can see that. Let's get it centered there. All right, here we go. There's my first graph, and this is the marginal tax rate as most people imagine it. Right? You start out at zero income. $0 income, you get a whole bunch of income there on the other side of the graph. And of course, as you go along, you pay more and more tax. Your marginal rate increases. That's how most people imagine marginal tax rate. And by the way, we should define marginal. Marginal means the tax you pay on your next dollar of income, not the tax you paid on your previous dollars, the tax you pay on the next dollar you earn. And for planning purposes, that's generally what we're dealing with. We're talking about the next dollar of income. Okay, so that's how people imagine it. Nice, smooth graph. This is really, let's see if you can see that. All right, this is much more real. All right. And you'll notice that this graph, I mean, the general trajectory of this graph matches that nice smooth one you just saw. But there's a whole bunch of undulation as you go through the graph. In fact, you'll notice over at the start of the graph that the rate's actually below the line, right? So people actually pay a negative tax rate. They don't pay tax at all. They get money back. And then there's all sorts of ups and downs. Now, I wish I could just ship this out to everybody and I could mark it and say, this is exactly where that is. But here's the thing about marginal tax rate. It's very individual, meaning every single person in the United States has a graph that looks similar to this, but each one's different because it depends on things like the amount of money you make, whether you're married, whether you have kids, whether you, how you buy your insurance, how you financed college. It depends on how you make your money, whether you're an employee, whether you are self-employed, it's highly individual. So though everyone's graph it looks this way, they're not all the same. So I can't you'll notice I didn't put specific dollar amounts on that bottom line. I put lots of dollars and $0. I didn't put specific dollar amounts because it depends. And so no, your average person, most of you can't sit down and say, hey, you know, if I make $10,000 more, this is what I'll pay. Or if I make 10,000 less, this is what I'll pay. Most of you can't do that. And you'll need someone who knows, you know, is my current income sitting here? If I make less money and I'm sitting here, I'm going to pay a whole lot less tax. That's maybe worth doing. But if I'm sitting over here and I make less tax, my marginal rate's actually higher, meaning on average, I'm paying more tax per dollar of income. Maybe if I'm sitting over here, maybe I want to increase the amount of money I make that year a little bit because with every dollar I'm making for at least for a little while, I'm actually paying less tax per dollar.
Right.
So most people need somebody to help them with that.
Well, looking on that, it looks like you've got some cliffs there. Is that true? I mean, what's a tax cliff? We hear that term once in a while. Maybe some people out there have heard that term. Looks like there's some real drop-offs. Do those truly exist out there?
Yes, there are a few tax cliffs, and a true cliff. And in fact, I'll be honest with you. I drew this little graph, and you'll notice the top rate I put on here is 50%. And I drew it very conservatively because I didn't want people to laugh at it when I put it up. I didn't want people to be like, that never happens, right? You can't ever have a marginal tax rate that's over 100% because that's common knowledge and it's broadly true, but it's not true with every single dollar. And so there are a few true cliffs, meaning where you make $1 more, you can literally pay more than $1 in tax on that dollar, right? You can pay maybe a few $1,000s because you made $1 more. It's not real common. I'm not trying to tell people, hey, you know, don't earn $1. In 99.9% of cases, it always pays to earn another $1. But there are a few that are true tax cliffs. One in particular has to do with health insurance. If you buy health insurance through through healthcare.gov or through one of the state exchanges, like the California exchange, and you are getting a tax subsidy, you're getting a credit for your health insurance, there is literally a tax cliff. And it sits at 400% of the poverty line, which is different depending on how many people you have in your family or in your household, really. So, but at 400%, if you make 401% of the poverty line versus 399% of the poverty line, there's a true tax cliff that could cost you thousands of dollars by making an extra $1. That's a true cliff. There's a bunch of other cliffs that are maybe more like really steep slopes. And there's a bunch of those. So for instance, I'll give you a quick example. Let's say you have the only income you have right now, let's say as of November 1st, the only income you have for the year is $40,000 of long-term capital gains. Now, that not very many people are in that position, but
Right.
this is hypothetical. So let's say you have $40,000 of capital gain income. That's all the income you have. Well, in that case, your tax rate for the year is 0, right? You don't pay any tax on that capital gain. But let's say you take a job starting November 1st and you start earning income. Well, and you're single, right? Well, now every dollar you earn in that job is going to be taxed at your normal tax rate, right? You're going to be in the what is that? You're going to be in the 15% bracket or whatever, on your ordinary income. But you're also getting taxed. You're also moving all of that capital gain income from the 0% bracket into the 15% bracket. Right.
Yep.
And so that's not a cliff. I'm not saying you shouldn't earn the money, but what I am saying is that for a while, essentially for $40,000 of earned income, you've got a really steep marginal tax rate because you're subjecting not only your earned income to income tax, but you're subjecting your capital gain income to capital gains tax rates higher than 0. So you have a steep rate.
I know I've had that in the past with a client dealing with Social Security. That's another area when you got that provisional income of Social Security that he thought he was in a 40% tax bracket. He thought the best thing I can do is give my mom, who's retired, some money and lower my bracket. And then they had whatever deal they had, that whether it was money he'd used to just give her, or whether somehow he expected to get it back. But he did all that on his own. He thought, great, I'm going to put to my mom, she's getting this small amount of money. There's no way it's going to be more than what I'm paying. He came in to get his taxes done, let me know what he'd done, and gave me his mom's information. Because of provisional income, he paid 55% on the money that he transferred to his mom. So instead of getting a deduction, he paid 15% more than if he would have just kept the money and paid it all himself and then given her whatever he needed to after the tax side.
Yeah, and that brings up a great point. Often we get, we look at the world kind of myopically. We just say, oh, well, what's the tax rate? Well, tax rate is a funny word. We have a way we define tax rate, but it's not always that useful because there are a lot of expenses in your life, in a lot of people's lives, that might increase based on your taxable income or based on your income, whatever, that don't show up when we say this is your tax rate. When your CPA says, "Oh, look, you're in the, you're paying, 37% tax rate and whatever." It doesn't show up. Mm-hmm. And there's a lot of those things. Things like, if you have kids, maybe it's a free and reduced school lunch at school, right? That changes, the amount you pay changes as you earn more income, right? Medicaid. Kids are on Medicaid. As you earn more income, maybe they go off Medicaid, and all of a sudden you've got a bunch of expense. That doesn't show up in the traditional tax rate calculation, yet it is based on income. So really, isn't it kind of like, at least economically speaking, for you, for the taxpayer, isn't it kind of like a tax rate economically speaking? Yeah, as you earn more, you get less of a benefit over here. There's lots of them. There's student loans.
I know college expenses I know are a big one people often ask about when they're looking at college funding and other things. They're trying to fill out government forms of whether or not they can qualify. And also they make too much money, they're not going to qualify for those benefits. So.
Yeah, and that's coming and going, right? So we have Pell Grants in college. And so depending on the amount of income you make, you can qualify or not qualify, or different amounts that you qualify for. And then there's the other side of it on the back side, on the loan side, right? You can enter into an income-based loan repayment program, which if you're making low incomes, fantastic. You don't pay hardly anything. But as your income increases, the amount that you pay per month increases very steeply. Again, doesn't show up in your traditional marginal tax rate calculation.
Yeah,
but effectively it's the same thing.
Yeah, it's definitely affecting your take-home income, the money you have to spend, which really is the key. We want to know how much money we have to spend and how much money we have to take care of the family. Ben, let's talk a little bit now about maybe some things people can do or as we get towards the end of the year. And if any of you out there have questions for Ben or myself, please feel free to post those. Happy to answer any questions that you have. But we've got about 20 days left, 22 days left in the end of the year. Anything people can do if they've not already done it that could help them lower their tax bill for 2020?
Yeah, that's always the question people have, right? They come screaming in here the last few days of the year and they say, "What can I do?" And you know what? There are some things you can do. We can work on the margins and we can change. And sometimes these are big changes. So, very common tip. Maybe a lot of your listeners have heard it before, but very common for you to come to the end of the year and you decide. And remember, you have to decide first if you need to reduce your taxes. So talk to somebody, talk to me, figure out where you are. But if you really do need to decrease your income and decrease your taxes, we're going to talk about first a few things you can do that do not ultimately cost you money. Okay. And the first thing is you can prepay business expenses, right? You're going to pay them anyway. So this isn't a situation where you're spending money to make money or spending money to save tax. This is it's just a timing issue. I can say, you know what? I've got rent on my office space. I'm going to prepay 12 months of rent on December 31st. Okay.
Yep.
Do that. By the way, just a note on that. Don't send your landlord. Today, don't write out 12 months worth of rent and send it to your landlord without telling your landlord. Okay. I mean, a couple things might happen. First, the landlord's going to get the check and possibly wonder what's really going on. He might just put it in an envelope and send it back to you and be like, you messed up. And number two, the landlord's a taxpayer too. So the landlord might not appreciate getting that check on December 30th of a month's worth of rent or a year's worth of rent. But you can solve that. One, by talking to the landlord, letting him know what you're doing. And two, mail the check on the 31st of December. Okay. Yeah. And then have proof that you mailed it. Mail it certified return receipt. That way you have proof from the IRS that you paid the bill and you're a cash basis taxpayer. You get to write it off. And two, you didn't inflate your landlord's income for 2020. He's going to get that check in 2021. He's going to recognize the income in 2021 because that's when you receive the check. So do a favor for both of you, not just yourself.
Great advice.
Okay. Make friends and keep them. That's all right. So there's expenses, not just rent. You can do that with, if you have advertising contracts, if you've got, I don't know, utilities can't necessarily be done, but in most cases, but there's a lot of expenses, a lot of reoccurring insurance, for instance, that can be made.
And I think people really need to look as well at, like you mentioned, at their overall taxes. I mean, be aware if you're down in the bottom brackets and next year you're expecting to make a whole ton of money, it's not to your advantage. You can't do income averaging. That's not something that's allowed when you look at it from an IRS perspective of just saying, hey, we're going to take multiple years and if we have a high year, we'll allocate it over to the lower years. But there's definitely planning that can be done to help you income average. Yeah, right. There's no reason. I was talking to someone the other day that they're in the bottom bracket. Next year, they expect to make hundreds of thousands of dollars, and they're saying, I need to write off more stuff this year. And you're like, no, dude, you're crazy. Next year, you're going to get a huge tax bill. All you did is hurt yourself to pay more money in the future. Yeah. In reality, what he should be thinking probably is, how do I accelerate income into this year, right? Yeah. Do I have, for instance, capital gains I could recognize this year since I'm such a low bracket? Can I get more income into this year where I'm essentially getting a tax discount so that I don't have to recognize it later in a higher year? Yeah, this is all goes back to that marginal rate discussion. Where you are, do you really need to lower taxes? But if you do need to lower taxes and first figure that out, you can certainly prepay expenses. But remember, there's always a cost. Yeah. If you prepay 12 months of your rent now,
You won't be able to deduct that next year. Just know that. Don't come to your tax accountant 12 months from now and say, man, I don't have any expenses. You know,
How many times has that happened to you been with a vehicle? How many times have you seen that where somebody's taken all their depreciation in 1 year and then had 5 years to pay the vehicle off, and they're going, wait a second, I've still got payments. Why am I not getting any large deduction any longer?
yeah, exactly. I have, or they come to you and say, what's my income? And I tell them their income, and they say, well, how is that possible? I don't even have that money in the bank. And and you say, well, remember that combine that you bought for, $190,000 last year, Mr. Farmer? Remember how you wanted to deduct all of it? Yeah, you don't have any money to make because you're still paying on those, but you took all the benefits. So just remember that these are tools you can use to decrease your taxes this year, but very few tools come without cost.
Ben, let's talk a little bit too about another side of it. One of the things that often people bring up, especially now people are working from home so much, any benefits at all for those who are working from home? I know there used to be some deductions for unreimbursed employee expenses. Is there anything they can do to try to make up for these home costs that they've had over the last 8, 10, 12 months?
So if you're an employee, there are no tax deductions for your unreimbursed employee business expenses. However, if you're being forced to work from home, and there isn't you might. What the first thing I would suggest is go to your employer, and say, man, I've incurred some expenses working from home. I had to convert that extra bedroom into an office. I had to remove the bed in there because it looks really bad in my Zoom meetings. I had to whatever. I had to buy a desk. I had to do whatever I had to do. I had to buy better internet because the internet at my house was horrible. I suppose the first thing I would say is, if you're an employee, go to your employer and bring that up. Now, remember, your employer's probably hurting too in this whole COVID thing, but that's the first place I would go. If you're
that's not going to be taxable, correct? I mean, if they would get those expenses reimbursed, if they've got legitimate expenses that they've incurred that the employer then reimburses them for, that's not additional income to them, correct?
Yeah, it's not additional income. In fact, and that brings up, taxes are such a large thing, right? I mean, they go on forever, but it does bring up a good point. I'll just mention briefly, a lot of employees and a lot of employers don't always use the tax-free mechanisms to get money to an employee, right? But there are a lot of them. For instance, if you're an employee and you can convince your employer that the employer needs to pay your cell phone bill, right? Your employer can pay your cell phone bill. Guess what? Your employer gets to deduct it and you don't have to include it, right? Whereas if the money just comes through your paycheck and gets on your W-2, you're going to pay money on that. You're still going to pay your cell phone bill. So, that could be the same with a lot of things, computers. And again, if you're working at home, office equipment, and there's a lot of other benefits as well, things like childcare or gym benefits, or, there's a lot of benefits like that maybe an employer could offer. It's still getting a deduction from the employer, but saving the employees some money. They might just want to be creative, both from an employer perspective. I mean, think about it from the employer's perspective. The employer might come to an employee and say, listen, this year I want to make your taxes more efficient. Here's some benefits I think would be useful to you. Maybe you don't get a raise this year, but I will pay for these, which effectively is a raise.
Right.
But it's not a raise. It's unreimbursed it's reimbursed employee business expenses. It's the employer making the decision that you have expenses that really belong to me, and I'm going to pay them.
Absolutely. Well, Ben, we're coming upon our half hour. I don't want to keep people too long. I know you and I could talk taxes all day long, and I'd have no problem, but I want to be respectful of those who are joining us this time. A couple of items I'd like to quickly go through if we could. If we look at changes because of the pandemic that have happened, any opportunities out there, maybe a business has struggled, lost some money, anything that can be done to help those people recoup some tax dollars?
Yeah, so this is an important part of planning this year. If you've lost money in a business anytime since 2018, 18 or 19, and of course 20 in the year that we're coming up on the preparation of those taxes. But if you've lost money in the last few years, it is likely, in fact, it's almost certain, that when you lost that money in, let's say, 2018, you didn't get any tax benefit for the loss. You're carrying it forward, yes, but you didn't get a big tax refund or anything because you got a loss. That has changed now. The IRS now allows us to take, because of coronavirus, allows us to take like a loss in 18 or a loss in 19 and to carry back the loss and offset income from prior years, specifically 2013 and forward. Okay. So a great opportunity. If you had losses, look at those. Don't try to do it yourself. It's very complicated. Go to your accountant, come to me. We can carry those losses back and get you what could amount to a very large tax refund, and basically immediately. Now, yes, the IRS is going to take some time to process it, but essentially immediately within 3-4 months, the IRS is going to send you a check. No strings attached, really. So look into that. Another one, this is a smaller one, but it might apply to you. If you made improvements to a business property, the interior of a business property, let's say you remodeled it, you put new light fixtures and and new windows and maybe some cubicles in or whatever. You remodeled a business property in the last couple of years, 2018 or 2019. In all likelihood, what happened on your taxes is the cost of those improvements were set up as an asset and depreciated over 39 years, which means you've taken almost no advantage of that expense yet. And by the time you're dead, you'll get through that, right? But we can now change that again because of coronavirus. We can go back into 2018 and 2019, find those expenses. We can amend those returns and accelerate the depreciation on those types of expenses. So another opportunity to just find an immediate expense. You don't have to spend anything other than maybe a fee for your accountant to get the work done. You don't have to spend much money to get a big benefit here. So yeah, absolutely do it.
Great advice. Well, we better wrap things up. I do want to make sure that those who are joining us, thank you for being here today. Hopefully those of you who are watching it later, if you have questions and want to reach out to Ben, how's the best way to get a hold of you? Give us some contact information here so people have access to that.
Yeah, I mean, you can always email me, ben@etrendsgroup.com, ben@etrendsgroup.com. Maybe in the description or down below this video when we post it, we can put even a scheduler link if you want to do some year-end tax planning and book some time with me in the next week or so. Just heads up, fair warning. Obviously, year-end tax planning would have to happen before year-end, and really to make it effective, it would have to happen really soon. So within the next week. But if you want to take advantage of that, I'm more than happy to sit down with you and look at your marginal tax rate graph. See, tell you where you need to be. Okay.
Yes, perfect. Well, thank you very much, Ben, for being with us today. Those of you who have joined or are listening to the replay, thank you for being with us. Next week, we'll be back, myself, CR, answering all your retirement questions again. So we will see you on next week's episode. Bye, everyone.
Bye-bye.